Welcome to What's in Store with Carly and Chris, the show where we cover hot topics at the cross section of retail and real estate. I'm Carly Iacono, and I'm joined by my co-host, Chris Ressa. Chris, welcome to the show. How are you?
Thank you. I am doing well. How are you?
Moving and grooving. It's been a busy start to fall, so grateful for that for sure. How about you?
It's been a busy fall, busy end of summer for me, and you know, uh, getting back into the routine with kids in school and all that stuff. So,
Don't even get me started. Yeah, that's nonstop.
do you have a
As
routine
always.
yet? Are you back in routine?
No, because it's still back to school night, parent dance meetings, random tennis matches. It's good, but it's all,
It's
variable still.
hectic.
So it's very hectic and work's crazy. So it's just a lot going on. A lot going on.
Awesome.
But maybe routine soon. We'll see. We'll see.
Yeah.
So we are talking about probably my favorite topic today of all time. And that is, drum roll please, the net lease opportunity. And we all know everybody loves grocery anchored retail, and we spend a lot of time on the quality of that and the tenants. But I feel like net lease has gotten some bad press over the last few years, and I'm excited to have a different conversation about why there is incredible opportunity in the sector right now.
Me
And
too.
I would just like to point out that this was your idea, not my idea. So this was not a self-serving episode, but I'm very excited that you thought of it. So here we
There we
go.
go.
Let's do it. So let's just set the framework. There's been a lot of headlines in the news, and you could really rarely trust headlines at face value, but there's been some retail closures, some of the drugstores. There's this plethora of discount stores on market. There's been some challenge within certain sectors of net lease, but there's so much more to the sector than these few storylines and few brands, which are not always bad anyway, right? So let's start with just kind of talking about one thing that I think is amazing. And we'll set the framework looking at net lease REITs, because there's a ton of public data available with the REITs. And the first thing I want to cover is occupancy percentages. And again, using REITs as the framework because that's where the data is most publicly available. So most of the REITs in the net lease space are showing occupancy levels. Actually, I don't even know that there's any that don't fall in this range, between 98 and 99% of their portfolio. 98 to 99% full occupancy across the portfolio. What was your reaction when you read that stat?
Yeah, I always knew it was higher, and there's sometimes you read a headline and been like, well, is that a true occupancy number? What are they? But at the end of the day, that is just really high numbers, right? It speaks to, well, one, for the net lease REITs, it speaks to the quality of their portfolio, but I do think it speaks to how high in demand those out parcels and freestanding buildings that are on the key corners and communities across America are. I think it speaks to the success of that type of real estate when you get that location, so many different types of uses and categories are successful because of how strong that real estate is. And when you look at any occupancy in any commercial real estate sector, it's rarely 99%, 98%. And so that's what I thought of when I saw that headline.
And I think there's a few other things that contribute to this. Like you said, the quality of their real estate. They're diligent in their acquisition strategy. And if there's a misstep or maybe they're overweighted on a tenant, they're going to rebalance that over time. So this is an active management of the portfolio, and they're very attuned to tenant financials and categories and things like that. So they are ahead of the curve, I would say, in managing risk from that perspective. But then the second piece I wanted to bring up is these leases are structured to have pretty long notice periods. So if the tenants are going to vacate, maybe at the end of a base term or the end of an option, or they're going a different direction, rarely do you have no indication, right? Rarely is it a huge surprise. So either you'll get a 9 or sometimes a 12-month notice, or longer if you're in touch with your tenant. So again, proactively, I think it gives you an opportunity with this long notice period to say, okay, XYZ is vacating. How are we going to reposition this? Are we going to sell the asset? Are we going to re-tenant it and then sell it? Will it stay in the portfolio? You have options when you have time and notice. So I think that kind of plays into the high occupancy as well.
Yeah, not for sure. I think one of the things you mentioned, one of the things that struck me is even with the predicted pending closures of some retailers, the occupancy is still going to be much higher than other asset classes in commercial real estate. That's one of the things that really struck me is, you see headlines of some tenant closures, and it's not really making a dent in the occupancy. And I'm sure many of those are going to be taken given the success of other locations on the best corners in communities across America, only bolstering the story of the strength of freestanding locations, net leases.
And that ties into the overall low vacancy rate that we're seeing across the market, right? And one thing we'll point out quickly on net lease, it's not just retail, right? Net lease industrial is a huge part of the market. There's net lease office, a lot of headquarter buildings. So really auto dealerships, really car washes, anything that is a freestanding building could be a single tenant net lease investment. So most of our show is focused around retail, but I think it bears note that a lot of net lease falls into the other asset types as well.
Sure.
But across the board, maybe office being, its own category currently, but across the board in the other asset types, vacancy is historically low, like we've been talking about for a few years. And retail is certainly the focal point for low vacancy and tenant demand combined to create those very high occupancy levels that we're seeing.
Yeah, I think generally speaking, right, net lease is a structure that can encapsulate any of the categories of commercial real estate. Net lease is really like the self-driving car of real estate. You just sit back, collect the rent, and let the tenant handle the operating expenses, right? That's the
marketing pitch. You should be a little involved, but yes, that is mailbox money, right? It got the nickname mailbox money for a reason. But I think, being proactive, of course, is important too. And I'm sure the REITs would tell you that it is certainly not a sit back and never think about it. But yes, based on the lease structure.
I'm sure people would say it's not a self-driving car, but
that is the goal, right? To get as close to that as possible. The second thing that really speaks to the durability of the income long term is the difficulty, or I guess the discount the assets are trading to replacement costs. So because the leases are so long term, 15, 20 years in a lot of cases, plus options, you have leases in portfolios and assets in portfolios that were put together 15, 20 years ago. And so the basis is pretty low. Now, if you were to build that same asset for the tenant, the cost would be much, much higher. So it's difficult to replace these assets just simply because of where construction costs are and the lack of available land, et cetera. So I think they're trading at that discount to replacement value, which gives them a lot of intrinsic long-term value as well.
Yeah, for sure. There's a lot of real estate that's trading at below replacement costs, right? Every office building probably in America is trading, not every, but many office buildings are trading at below replacement costs, which is, said differently, it's like buying the whole car for only the cost of the engine. And so I think that it's something that it's you can't eat that, but it might not be in the actual model, but when you're looking at the opportunity cost from an investment, it's a very very interesting data point to look at to say, like, if I wanted this asset class, I wanted this property, and I needed to build the like-kinded today or tomorrow, and there was no way that I could do that, and I could at this price, it makes you think about the investment in a different way.
I agree. And to your point, that does cover some other asset types, but it certainly does hold true here. And a lot of these buildings, I'll add, are built to suit for the specific tenant use, right? That's the nature of single tenant. So it's much harder for these tenants when they have a very specific prototype, or if it's a manufacturing facility, right? They have very sticky improvements in a lot of cases. So it's harder for them to just say, okay, I'm going to move, up the street 2 miles. That's a different move than just having a vanilla box space. So I think that the difficulty in replacing the asset is compounded because of the nature of the built-to-suit
Yeah,
product.
and when you talk about the opportunity, the one reason that I think it's interesting in net lease is because, you know, cap rates were rising, or said differently, the price was falling a bit for some of these net lease properties. As the price fell, construction costs, maybe they stabilized, but the replacement cost didn't really come down at the same level. So the gap between what you could buy it for and the replacement cost has widened. And I think that is super interesting,
I agree.
making it an interesting opportunity.
Let's go back to the durability of the income stream for a minute, because this has really been attractive through volatility in the market, because these are long-term leases, often with structured rent increases, more often than not, I should say, with, in a lot of cases, credit tenants. You have predictable cash flows in a time when other asset types, not to disparage any other asset types, but are being impacted by rent control or things really outside of the landowners or the property owner's control. So with net lease, you have a stability that you don't see elsewhere, which is another reason it's so attractive. And you touched on this earlier. The tenant typically covers all of the operating expenses, right? That's your three nets: taxes, maintenance, and insurance. So in the purest form of net lease, there's no bleed, there's no risk from the expense side to the investor. And as we've seen the last few years, there's been a lot of fluctuations in taxes and insurance and things that, again, are outside of the owner's control. So adding that lease form with those protections along with the long time frame really gives this durability of income that you just don't see anywhere else, in my
I
opinion.
think the durability of income is even, the comparison should be made not just to real estate, but to outside of real estate. If you were buying some, a tech business or something, right? There's a lot of,
Mhm.
or other asset classes. The durability of income is super interesting, right? If you have a strong credit worthy tenant on the hook, the cash flows are like the Energizer Bunny. They just keep coming and coming and coming, right? So like, they keep going and going. So I think that is very different than many asset classes, right? When economic times are tough, the cash flow should be in place as long as the underlying credit is, what you thought it was.
And there's so many ways to look at tenant credit, right? We have investors who only buy investment grade tenants. Then we have clients who, big and small, who play in the middle markets, who don't look at any credit deals, right? We have some that love the first generation businesses, that they can do sale leasebacks with. So credit is an interesting conversation point, the strength of your tenant, but that's not what everybody goes for, right? Because sometimes they're looking for opportunity in the non-credit space. But that's a way, I think, if you are getting the investment grade credit, you're getting the bondable absolute net lease. I mean, that is where you're really taking out any fluctuations or ambiguity in that whole period.
Yeah, it's a, what I would say is, like, how much are you buying the income stream versus are you buying the real estate, right? And the ones who are more focused on the location and the long-term viability of that location, are a little less concerned about the credit. Well, then maybe they can buy that net lease at even a bigger discount, right? In the 8s, 9 caps, but knowing that that income stream is not so durable, but they're less concerned about that because they're looking 10 years down the road of what they could do with that real estate for the next iteration.
Exactly. And it could be, it's not really talked about this way, but it could be a covered land play in that case, right? If you don't believe in the tenant as much, but you'll probably get some income for a period of time, but you love the underlying real estate, that's another investment strategy, which is what makes the asset class so interesting. There's a lot of different ways to look at it. Instead of credit, you also could focus on the real estate first and the mission criticality of that for that business. So not just is this a good location, but is this a crucial operation or crucial distribution point for whomever the tenant might be? And then you really have a very sticky asset if you know that it's crucial to their business operations. Whether that tenant's business goes up or down, you know that this is a piece of real estate that they're going to need to hold on to stay in business. So that's another way to look at it, or another way to get security, even if it's not an investment grade tenant.
Totally.
All right, I think the next thing we want to look at is the institutional appetite. So net lease is often talked about with the 1031 buyers and the private capital. And then on the other side, you have multi-billion-dollar funds and REITs and alternative asset managers who are exceptionally active in the space. Now, for many, this is not new. Net lease has been a focus for 20 years. But what's been really exciting to see is in the last 5 years, the focus from institutional investors has increased to, I don't know the multiple, but staggering numbers. I would say this is because of, the COVID black swan and all the volatility in the market that we've seen. I think a lot of the more institutional investors are looking for predictable yield over time and realizing that net lease, when approached carefully and diligently, is a fantastic way to get that. So there were a lot of notable trades last year with some of the biggest names in net lease, to the tune of 500 million, $1 billion here, consolidation of different funds. It's been a really, really active year on the institutional side. So I think that's important to put out there, because when you read a lot of the storyline, it's, 1031 buyers are quiet, or there's not the same capital. And that is maybe true because of the slowdown in other asset types as well that's affecting the 1031 exchanges. But from the broader perspective, if the institutions are pouring money in, there's a reason. And I think that kind of speaks to the asset type overall.
Yeah, I think when large institutions are pouring that kind of capital into a sector, you have to take a step back and start looking what is the opportunity that they're seeing, right? I think one of the big ones is, because net lease is, it's not some new product type. I just think what they're valuing the credit at versus the rise in cap rates has been a big part of this, right? The price has gone down, and at enough of a spread to their weighted average cost of capital that it makes it an extremely interesting play. I think if I'm which I'm not, I think the small investor who is looking at this, right, goes, well, I can't play that game because, I have to go and get a normal mortgage, and I have to, I'm looking at this from a totally different lens. I think that is probably true. They have to look at it differently. And I don't think that my point to that, your comment would be, I don't think that is necessarily a negative on the asset class. The asset class has remained rock solid. Retail net leases have remained rock solid. What's changed is how you've capitalized it, and maybe it's not a financial engineering play. it's a real estate play, but it didn't change the quality of the real estate, right? What I think like some of the narrative came is like, between some closures and rising prices due to or lowering prices, rising cap rates due to interest rates and 1031 money pulling back, this like narrative came to the asset class, like that a freestanding retail asset was worse than it was in 2022. And I think to me, know how the deals got capitalized, who was investing in them might change, but the fundamental real estate didn't. Those locations are still really great locations. They're great assets.
Yeah, I think that you hit the nail right on the head when you referenced cost of capital. That's what flipped the script of the stability of the asset type on its head the last 3 years. So interest rates rose, cap rates have risen, but not in tandem, right? Not with the same spread that there used to be over interest rates for some of the especially lower price point deals, the entry level net lease deals. So the yield hasn't looked as attractive for the last few years when you layer on financing. That doesn't speak to the lack of quality in the asset. Nothing's changed, broadly. There's been some
Unit
tenant
level
bankruptcies.
economics are still strong.
Exactly.
The creditworthiness of a lot of the retailers are better than they were. Like there's so many good things about the actual real estate. But yes, if you weren't buying it because of the real estate, and how you capitalized it could be of a challenge.
But I think that brings us to why this is such an interesting time to buy. And I think that window is narrowing because cap rates have risen. Interest rates will hopefully, fingers crossed, be cut right around when we're releasing this episode. So we're going to start that process of lowering cost of capital, but it hasn't happened yet, right? So we have elevated cap rates from 2-3 years ago, and we have still a high cost of capital, but that's going to be changing quickly. So I think you can get in at a better yield than you could historically and at a better yield than you'll be able to in a year from now. That's my prediction, or maybe even 6 months. And maybe you need to take on some floating rate debt. Maybe you need a mortgage with no prepayment penalty, or you need to ladder some of your maturities if it's a bigger deal. You've got to be creative with your debt structure right now if you need financing. But I do think it's a time to come in at a better basis for the asset overall than you're going to see in 6 months. So you've got to be creative. You've got to have a stomach for taking a lower return now. But I do think that spread is there, or will be there if you get in now.
Cool.
We'll see. I sure hope so. But no, I think rates are definitely coming down, which is going to be good news and should free up a lot of capital and get the market moving. We've already seen it in the last quarter. People are jumping back in, and the pace of deal making the second half of this year has been much different than the first half. So we're excited to see that. So if you're anxious to get into the market, I would say now's the time. Institutional competition's definitely heating up and private clients are coming back. So get in while you can. If that wasn't the most brokery thing I've ever said, I don't know what it is, but it's true. It's true. This is a unique period in time to find yield and opportunity.
Cool.
All right. Thanks for giving me a soapbox to talk about why net lease is amazing. It is true asset class we love, and happy to share some of the opportunities we see moving forward.
Awesome.
As always, thanks for tuning in. That was this episode of What's in Store with Carly and Chris. We appreciate all the listeners, and we hope to see you again soon. Thanks so much, Chris.
Thank you.